Hey, you talking to the prophet. Hey, hey. We talking condos and nice clothes and driving Lambos. I remember them night codes, we couldn't stand those. We tried to drive on them house roads, but had to stay low. Now there's solutions to hard bills we couldn't pay for. I talked to Profit to get some profit, we couldn't change the top. If it's a stock and I need a cop it, I wait for him to drop it. Ain't no option, let's get it poppin', we chillin' in the trap. I need some crypto, put it in my pocket, by any means I rock. This is the Profit with Nick Black, it's time to chit chat. You know nothing about blockchain, we here to fix that. You want the news on them new stocks, this where you get that. So go and grab you a nice chair. It's time to sit back and talk to Profit. Hey, hey, you talking to the Prophet. Hey, hey, you talking to the Prophet.
Is it not working? Hold on. I rebooted everything. I did a little rebooting. Only music. Okay, cool. Yeah, sometimes if I turn this thing on out of order, it picks up one or the other. Today, the camera wasn't working, but everything goes through the mixer. So tech. So let me say hello to Antonio, Biotech Breakout, VideoTuber, CC Brown, Solid Gold, Lupino, Sniper Princess, Aaron, Troy, Gordon Bennett, and okay, cool. Let's go over to the YouTubes. Antonio, first in the chamber. What up? Let me say hello to Brady. What up? Let me say hello to Scott Hill, Biotech Breakout on the other side, Surf Tech, Todd B. Bon dia. Johnny Midas, what's up? Jeffrey and Sylvia. Okay, cool. So kind of a quiet little group today. So we're going to I'm going to go through a couple of interesting little bits, quick price stuff, and then I'm going to talk to you guys about an essay I read, which is kind of deep, but it's important for you to hear. Dave, Ash, good to see you. So I'm going to read it. So you're going to sit back and just kind of relax. And I'll throw up some graphs every now and then when it's germane to the discussion. But this is mostly going to be one of those ones where you just absorb brain bits. Tube Debt Pipeline, what's going on? All right. So before we get to that, let's go over here and let's launch our morning. Let's see. You can ignore me. I'm not ignoring anyone. Oh, hold on. Lori, what up? Adam. Yeah, I don't know why. It went right past. Yeah, sorry. Okay, so we're going to go to our commercial, non-commercial breaks, and then we'll get right back, and then we'll get to it. Yeah, so there. So there you have it. Okay, and Barno, Jim, P. Kelly. I think I pretty much got everybody. Let's see. Okay, let's do this. We don't want suspicious music as we go through prices because there's not really anything suspicious going on. So we'll go with some nice little cool music. Let's see. Oh, Breed My Love. I'm not going to dig into the name, but welcome. You could go in all sorts of directions there. The Real J. Cole, Joe Pirate, what up? Okay, let's look at prices. And real quick, nothing. No, I don't want to. No, I'm not going to connect MetaMask. Weird. So weird. Okay. The Bitcoin's right at 40K. Cool. It's up 25% on the week, 26%. There's all sorts of people coming into the Bitcoin. So it's important. Everybody's talking about inflation, and a few of them even have it right. And when I say a few of them, it's probably no one you've heard on CNBC. And even what you think you're hearing from Tudor Jones is not what you're actually, what you think you're hearing is not what you're hearing. So we're going to talk about inflation today. I found a really good essay that explains how you shouldn't be buying into the inflation narrative, and you certainly shouldn't be using it to defend Bitcoin and cryptocurrencies, because it's the wrong narrative. It's cannon fodder for people to dismantle. Now, it's fair to say that most people don't understand what inflation is, but you people will. You people, I don't even know if you can say you people anymore. I think that even has some kind of weird connotation. You can't say you people. It's extremely intolerant. Ethereum 2548. It's pretty much flat on the day, up about 8%. Cardano 156. It's up 8.5%, 1% down, flat on the day. So everything had a big bump the last 2 days. It's kind of quiet today. Polkadot is up. Anybody know that there's some Polkadot news? Yes, it's being listed on Coinbase. So you can, I think they're accepting inbound transfers of Polkadot into Coinbase Pro starting tomorrow or Thursday, or it may already be. I'd have to go look at the news article again. But anyway, yes, Polkadot coming to Coinbase. You can expect that staking is also coming to Coinbase soon thereafter. They're not going to let, crack and eat that business. What else is interesting? Let's see. Matic is popping slowly back up. It's still a good place to buy, in my opinion. If you believe that Ethereum doesn't go away, then Matic makes a lot of sense right now. And a lot of companies keep using Matic as their solution for Ethereum problems. So, hey, parachain auctions, Matic helping. This is the month, the quarter of the protocol layers. So pay attention. It's also the month of Theta. We'll see what happens. But you'll notice the weekly on all these things popped up. Almost every asset, except for stable coins, right? What are some of the other big winners? Well, Telcoin is up 37% on the week. It's not terrible. Bitcoin Candy Expat Matt, what up? Darting uphill, also what up? Who else is a big winner? Pretty big winner. Engine, although Engine oversold, near oversold. Look at Rune. Look at Graph, 13%. Look at 1 inch, 21%. OGN, it's still beneath $1. I don't know. My faith in OGN is starting to erode a little bit. It's a cool project. They're just not grabbing the investor buck. But then again, investors are buying meme coins and stupid stuff with cat heads and crap like that. Audio is up. It's down on the day, 5%. It was up 16 on the week, so it had a nice little bump. Fetch, basically flat. Down 4, up 4, flat. Stormix up 8 on the week. And AGIX, that's part of that whole transition. Matrix AI is up 28, almost 29% on the week. So kind of a big winner. But look, on its yearly, it's only up 2. If you want, and this is an Antonio play, and I'm not telling anyone to buy it, and certainly don't use their wallet or their staking, but if one was to try to get exposure to the AI space in a relatively early venture, I would say Matrix AI Network is one way to do it. Be very careful how much currency units you put into this. This is a lottery ticket, right? Matrix AI is not Fetch, and it is definitely not AGI, but it's something you should look at. Okay, cool. So we've done that. What's going on the Cointelegraph Markets Pro? So what is interesting here, I thought Polygon is back up in the getting close to buying it range. It's at 83. Remember, we like it at 90. We don't like it at 86, at 88. We like it at 90, based on all the metrics in which it scores. Voyager tokens kind of floating around. Thor kind of floating around. I am a buyer of Thor chain for other reasons. I think it's a protocol layer. It connects protocol layers. Based on that, I'm interested in it. And so I do have a position in Thor, and I'm slowly building. I feel like I can keep building to about $15. So that's me. That's my number. Your number is going to be your number. Ella Paul, what up? Pablo, what's up? So, yeah, there we go. Let me see who's over here. We have Hootie. We have Unsung, Belinda Cook, Stress Relief, Spirella. I think we got everybody over there. Cool. Okay. So here's what we're going to do. Let's look. There was a couple of other interesting pieces of little news tidbit. One was, so Paul Tudor came out yesterday and said he's raising his exposure in his portfolio to something nearing 5%. Ocean Dawn in the house. 5% is a freaking lot. Especially, Tudor is not a joke. Tudor has real money. And people listen to him. And so then it got into this greater discussion of this assumption that hedge funds will hold between 7 and 10% of their assets in crypto in the next 3 to 5 years. So I thought, let's do a little math real quick. Hedge funds will hold between 7 and 10%. That's 3.8 trillion is currently under management. That would be 380 billion. You can expect that to add at a minimum of about 50%, because all money flows into, and we're going to talk about this in this essay that I found. Aaron Segal wrote it. And in this essay, it's really interesting how he touches on these different areas. And some of it will be over your head, and some of it will be quite obvious. But I would just urge you to keep kind of absorbing. Now, if just hedge fund money, right? So let's say it's 4 billion. That means 4 trillion. That means 400 billions coming into crypto as a minimum. And that's just on the hedge fund side. You think, okay, what's after hedge funds? Pension funds, sovereign wealth funds. What's that look like? Way bigger. Pension funds, total worldwide investment, 5.6 trillion as of right now. And remember, a lot of the US-based pension funds are wrecked. They are in trouble. They need help. They need bailouts. They need state money. Where's that money going to come from? It's going to come from somewhere. You're going to create it out of thin air. Well, they're really not. They're going to rob the future. They're going to rob future prosperity and channel it back in the form of debt. Why wouldn't they? That's what they do. And as long as the future is always going to be better, everything's always going to go up, markets never go down, then that's fine. But what happens if that's not the way it works? Anyway, so pension funds worldwide, 5.6 trillion. 3 to 5 years from now, let's call it a clean 6, not counting all of this ridiculous stimuli. Sovereign wealth funds, 8.2. Think about that, 8.2 trillion. We haven't even talked about gold. 7 to 11 trillion. These numbers start adding up. Not even counting gold, now you're at 1.38 trillion. Okay? You add in hedge funds, you're at about 1.7. You add in even 10% of the gold market, which we know it's going to be at least half. But even if we just say 10, that's another 700 billion to 1.1 trillion. So now we're at what? 2.5 trillion on top of we're not at 2 trillion right now, are we? So think about that. So think about how much. So it's a clean, just these funds taking Bitcoin onto their balance sheet. It's not talking about governments, banks, investment banks. Remember, no more Glass-Steagall. So just the money that's already there right now waiting to get exposure puts a 2x on the market as it currently stands. Just look at the market, times it by 2 over the next 3 to 5 years. And obviously that's not going to go down the list all the way to asset 9,000, poop dumpster and jerk coin and all this kind of old stupid crap. It's going to coalesce at the top, mostly with the winners, mostly with the veterans. So you can see the writings on the wall. Come on, common sense. What happens when these little these smaller governments, your El Salvadors, your Paraguays, your Bolivias, your Perus, Honduras. What happens, Ecuador? What happens when they all start taking Bitcoin onto their balance sheet and call it whatever they want? Legal tender, help the man. Nah, doesn't matter. Treat them like companies. And then what happens when the bigger banks and the quasi-central banks, because there are no real central banks, when the quasi-central banks start taking Bitcoin onto the balance sheet and other assets to a smaller extent? So you have to kind of, keep in mind that these things happen slowly, then way too fast, right? Barely at all, and then all of the sudden, right? So it's important to understand the context, the macro context. That's why we're going to talk about the thinking too small and the pitfalls of the inflation narrative. Bum, bum, bum. This is important. So that's what we're going to talk about today. Let me say hello to Theot, to DJ Wyatt. Hello to you all. Cool. Okay. So as I go into this, I'm going to bring up my little cool thing. I have a couple of charts that I will show you as we get there. And hopefully this will work pretty easy. Let me set it up. Okay, yeah. So I think I've got it set up. So we'll go down a little bit there. We don't really need music playing, do we? Do we? Let's see. Tom, good to see you. Brandon, what up? No smoking jacket. I know we were going to try to do that. Dubai Money, Garth, what up? Slow and steady. Slow and steady doesn't win the race, but you don't crash. You don't crash out. So I think that's valuable in and of itself. So today, sit back, relax. This is not a visual presentation. I will serve a few charts. Okay. But this is not a visual presentation. This is thinking too small in the pitfalls of the inflation narrative. Jared, what up? Good to see you, buddy. Okay. Chart number 1. The one chart we need to study and why Bitcoiners, and I would say people in the crypto space in general, need to move away from the 70s style inflation thesis. The first chart plotted below is deceptively simple and yet extremely important. I would even make the argument that that it is the most important chart to fully internalize in 2021. This is the signal through the recent noise of messy economic data and a bunch of ignorant idiots, loudmouth noisemakers on CNBC, CNN, NBC, MSNBC, Fox, and every other jackwagon news organization that thinks that they can distill all of the machinations of economics into lumber's more expensive. So no. All right. Chart number 1. This visualizes the nominal gross domestic product, quarterly GDP in actual dollars, which is annualized, divided by the employment to population ratio, most commonly defined as prime age workers, age 25 to 54, as a percentage of total population. Okay. It goes up and to the right. Looks a lot like Bitcoin. Okay. So the signal, what this chart's telling us is that already a year after COVID brought the biggest employment shock in modern times, we have somehow produced higher GDP in dollars relative to labor employed. Ever. So think about that again. Biggest shock the world has seen since the early 1900s with the Spanish flu, or you could say that one of the world wars, probably World War II. And a year after COVID, the biggest unemployment shock in modern times. All of these people unemployed, made unemployed, gone, go home, stop working, sit on a couch. We've produced higher GDP, gross domestic product, in dollars relative to labor employed. Ever. Okay? It's kind of a big deal. Boom. Chart number 2. And again, I'll get away from these charts, but it's important to find a way to visualize this stuff. Chart number 2, plotted on this screen, is simply meant to emphasize where our employment levels currently stand in a historical context. It shows us how incredible the GDP growth is, despite there still being approximately, and this is the good numbers, this isn't the real numbers, this is the admitted numbers of 15.35 million people currently filing unemployment. This doesn't count people that are unemployable or people that have left the job search. They also are unemployed, but they're not filing to collect the check. This is only the people collecting the check. You can double this number or triple it easy. And then the numbers start getting realistic. And then you start thinking, wow, 10 to 15% of all America is unemployed. Think about it. Even in the Great Depression, it was only 25% unemployment. Well, that's the real number, right? The shadow number. You think, oh my God, yeah, but that's still 75% employment. So 15.35 million people filing for unemployment claims in this country as of right now. This compares to about 1.6 million people filing claims prior to the COVID crisis. So right before COVID, 1.6. So this is a 10x of unemployment. Unemployment's gone up 1,000%. Okay. And so when you think that 1.6 million people were filing claims prior to COVID, GDP was 21.8 trillion. Gross domestic product. Okay. You see this spike. You see this big fat ass spike towards the right side of your screen. Okay. So let's think about this for a minute. Currently with GDP at a new high of almost 22.1 trillion, we've accomplished a 1.2% nominal GDP growth rate in defiance of a 10x increase in the unemployment number. Right? You should go, what the F? How is that possible? When you ask, we all know that something doesn't feel right. We know. You look around and you know things are effed up. But it's tough to express that. It's tough to quantify that. Because there's always some dickbag wearing a suit that goes, well, you just don't understand how powerful and strong are. It's all bull smoke. Okay? But it's bull smoke for different reasons than you probably think. When I go through this essay, you're gonna go, oh yeah, that makes sense. That makes sense. But it's all of this hidden wealth destruction. It's hidden debasement. It's not the lumber and copper and the shit right in front of you. It's this embedded, hidden, slow erosion of your buying power. Even the admitted numbers, when you do the math, are staggering. I'm going to just leave this with you, but the government is saying really quickly, the Fed, this is not in the essay, but or maybe the Fed is saying, okay, 2%, 2% is the target. What does that mean? If 2% is the target, then really they're allowing for some other number much worse than that. But let's stick with their 2% number. Do you know what 2% inflation or debasement of buying power, robbing from the future? Do you know what that is year on year on year, 50 years out? 20 years out, get a calculator, take any amount of money and multiply it times 1.02 times 1.02 times 1.02. It's like compounded interest, only it's destruction of your buying power. Year on year on year on effing year, and pretty soon you can't buy shit, and you wonder why houses flip in value. Oh, every 10 years your house doubles. No, dummy, it doesn't double. Your buying power is decimated. And we're accepting it because 2% sounds better than the real number. And even at 2%, you get destroyed. You factor in property taxes, done. They steal all of your shit back from you. Yes, we get to use the pejorative they. All right, let's continue. All right, so I know many skeptics argue that such a rate of GDP is not sustainable and is driven by temporary and synthetic demand from high transfer payments and the inflated personal income and spending that comes with all these government programs and the free checks, right? You sit at home, you collect the check, you have more money, da, da, da. And while these are true, these are facts, right? It's missing the kind of main point. The point is that our economy can handle such a demand at current levels of employment. The other way to look at that is that our economy doesn't need to re-employ all of those people that are gone. The between 15 and 45 million people that are not working, they're never coming back. On the aggregate, they're not coming back because those jobs are not coming back. Those jobs are gone. And this is a product of deflation. So everybody's like, oh, eggs are going to be more expensive. Bitch, there's 45 million people that don't have jobs, and those jobs are never coming back, ever. This needs to sink in. If Powell and the Fed are watching this, they'll certainly be, kind of grinding their teeth and wincing anxiously. If one's goal is full employment, as the Fed says, we want full employment, maximum price efficiency, we want maximum spending power for the homeowners, inflation of, the 2-3-4 mandate, 2% inflation, 3% GDP, 4% unemployment, right? Why? Because it's easy to remember that for people that grew up in the 40s, right? And grew up on black and white television was like a new thing. They missed their A tracks. So if one's goal, if their mandate is full employment defined as getting job levels back to pre-pandemic levels, then these facts should be alarming, because you start to go, what if we don't ever get back? And there's a good chance we won't ever get back, right? So the emergence of a new debate, the deflation debate, and you'll hear people like Jeff Booth. And I think Jerry interviewed Jeff Booth. So go look, if you get a chance, go look at Jerry's videos, Jerry V. Hall, and see, I'm pretty sure he interviewed Jeff Booth. I know he's had a lot of really good articles where he explains his thesis on the deflation effects of a society that enters into these cool technological advances, right? So some signal-oriented thinkers like Jeff Booth have done an excellent job in delivering a message that frames the hurdles for a system of a debt-based fiat, right? A system that necessitates higher inflation to propel it forward with an ever-increasing secular headwind of deflationary forces. Such forces result from the productivity fueled by exponential technological innovation. You can just think all this cool new shit, right? It gets cheaper and cheaper to make, and it gets spread out, and it gets to touch more people, right? The middle of a jungle in sub-Saharan Africa, people have smartphones, right? So it's an increasingly digital world that we live in, and it simply doesn't require human labor at the same scale as in the past. Meaning and that's why we said a lot of those jobs that went away, they are never coming back. And sad news to you, if you're one of those people that got made quasi-unemployed by all this, your job's not coming back. It's very likely that your job doesn't exist. Humans are less and less needed every day. Okay? It is what it is. The oversimplified dichotomy of inflation versus deflation. So when I say my view, it's Aaron's view, because it's his essay. In my view, that fellow Bitcoiners will be better served to stop broadcasting the inflation and hyperinflation narrative as the primary reason to migrate to the hardest, most decentralized money ever invented. And while I would disagree, I don't think Bitcoin is money, but it's definitely safety. And I like safety. Such a narrative has the unintended consequence of reducing Bitcoin merely to a digital gold alone. See, I say that's okay. I say that Bitcoin as a digital gold is extremely powerful, but that does limit some of its real promise. So it's better suited for the times that we live in to look at the story of deflation versus inflation and the hidden inflation factors, right? So the other flaw in the inflation tale is it could very likely not ever occur, or at least not in the 1970s era manner that many are expecting to unfold, right? This 10, 12, 15, 18% inflation. The world is so utterly different from the decade of the 1970s that such a comparison is almost nostalgic in its oversimplified and stale rationale. However, before the Bitcoiners explode at this statement in defensive recoil, let us pause and take a deep breath. All right. We don't need this narrative at all, right? You don't need to say inflation and hyperinflation is coming, and that's why Bitcoin. We don't need the inflation narrative to unfold in order to be victorious by owning Bitcoin and other digital assets. And this is specifically talking about Bitcoin and these non-inflationary tokens, which Ethereum is not. When viewing the above charts, or the chart that we just looked at, it's a good thing that we're not just counting on inflation, as the old argument would say. Bitcoin opponents, they have this kind of straw man argument, and it's very easy for people to look at our inflation argument and say, well, that's clearly wrong. That's a simpleton's argument, and it is. And so that's why it's important to understand how inflation in pockets, inflation on the aggregate, and deflation all kind of, they're homies, right? They all work together, okay? So don't subscribe to the inflation myth. Learn more about inflation. So it does not mean that inflation in some phase state is not occurring, but money is not necessarily inflating in the old Keynesian textbook definition of more dollars chasing fewer goods and services, defined by such measures as the consumer price index and other economic inflation gauges that use average and aggregate prices based on a basket of ever-changing and hedonically adjusted components. Alas, the circumstances are much more nuanced. Money is inflating, but it's doing so via money entropy rather than in the way of the superficial consumer and services headline aggregate inflation that we typically use as our barometer. So if you put a basket of assets, if you take a bunch of crap and you put it in a basket and you measure it each month and you see how much did it cost last month, how much did it cost this month, it's inflating in price. And if you just look at that, that's typically CPI, Consumer Price Index, right? And, these numbers change over time. It's calculated differently than it was in the 70s, and there's some arguments there. But the point is, you use CPI to compare to CPI, right? It's compared against itself, but it's not enough for that to be your barometer of what is inflation or deflation, right? So for deeper dive into the theoretical framework of monetary entropy, he did a really good essay called Bitcoin Information Theory. So again, it's Aaron Segal, Bitcoin Information Theory. For those of you that really want to dig super deep, get your brain boxes blown up. So currently we're witnessing a lot of noisy post-pandemic reopening statistics, misleading base effects, and short-term supply shocks after a year of lockdowns and severe economic disruption. These strange times breed a tremendous degree of confusion and overwhelm us in a cacophony of noisy data. Nevertheless, we must see the forest for the trees and not succumb to the yearns of the past. Memes such as "OMG, look at lumber prices. They're low-hanging inflationista fruit, an empty vessel of clickbait." This is noise. It's signal that is telling us that businesses have accelerated their shifts of productivity, automation, and digitization already well underway over the past, over the past 20 to 30 years. The ability to do more with less human labor. So this is immensely more deflationary. So if you compare the inflationary effects of lumber prices and some products that are having a hard time spinning back up the wheels of business and the gears of business versus the deflationary effects of new technology and automation and productivity and digitization, they are kind of incomparable. And the deflationary effects are immensely more powerful in the long run relative to the short-term commodity-driven little inflation effects. And he has a really funny quote from the Hitchhiker's Guide to the Galaxy by Douglas Adams. He said, "Since we decided a few weeks ago to adopt the leaf as legal tender, we have, of course, all become immensely rich." So fixing the quantitative easing narrative. Yes, QE is not actually printing money. Who talks about this all the time? Jeff Snyder. But it is printing moral hazard, okay, and turning speculative financial assets into implicit bearer instruments, right? YOLO faux show. Quantitative easing is indeed insidious money printing, but not in the way characterized by most financial analysts and pundits. The real nuanced mechanism is actually much more problematic for fiat, as it is significantly more financially destabilizing. This is because rather than injecting fresh capital into the real economy in the form of fractional bank reserves that enter monetary circulation through the extension of credit, such avenues are circumvented in favor of speculative asset vectors, right? What does that mean? It means that the idea that moving bank reserves around forces these banks to extend credit and cash availability into society, it's not happening. It gets to the bank and then the banks stop, period. And that's problematic for so many reasons. Let me continue. Given speculative assets ideally have free market pricing mechanisms, we don't have a free market, right? Imagine if we did. However, given speculative assets ideally have a free market pricing mechanisms that can real-time make these adjustments, financial markets will constantly test the political resolve to support them, right? Such is a very important distinction relative to the behavior of the more deliberately real economy and kind of real business that lives outside of the domain of financialization, a domain that is shrinking by the day. In 2011, rockstar venture capitalist Mark Andreessen famously opined, software is eating the world. This is in 2011. But well before 2011, financial assets were already eating the world in much larger quantities. Financial markets crave certainty in order to establish this equilibrium and fair value prices and confidence, right? The problem is the equilibrium is not achieved when government regulators and central planners and politicians come in and start cheating and start diverting, right? Over time, when such tests are repeatedly iterated, history has proven a desire on the part of policymakers to maintain market confidence at all costs. Think about the Fed. That whole idea of the Fed put, the whole idea that the Fed, signals and that we should all behave based on what they say they might do at some point in the future undetermined. Such a dynamic also adds to short-termism as the incentive structure for typical politician, technocrat, bureaucrat, central planner is etched along a very short time horizon and becomes matched by a new equally short time horizon for financial markets. So this realization becomes ingrained as a pattern of moral hazard and begins to dictate policy decisions to a great extent. Once the government itself becomes reliant on quantitative easing to finance its own spending plans, it's game over. Even if it's not real money, it becomes real money because it creates this big cloak, this big murk of moral hazard, right? And again, let me continue. So these counterproductive incentives become too difficult to overcome. Humans are humans. This is why moral hazard is so dangerous. Such bridges once crossed become very difficult to retrogress. There's no going backwards. Politicians don't get hired on the let's initiate austerity platform. People are like, F you, I'm trying to spend money now, bro. I want a bigger house, sucker. Stocks and bonds as the embodiment of fiat currency. Money supply relative to economic activity as measured via the M2 money supply divided by GDP is now 60% below its peak in 1974 and has been in consistent but sharp decline ever since the financialization of our economy began in earnest in the 80s. Meanwhile, the stock market cap relative to GDP has gone from 40% of GDP in the 70s to well over 200% of GDP today. It's an all-time high. It's actually an all-time high today. So this is perhaps one of the most stunning facts to internalize out of everything that has been written. I'm going to read that one more time. Okay. Money supply relative to GDP is now 60% below its peak in the mid-70s and has been on sharp decline, right? The stock market capitalization, market cap of the equity space relative to GDP has gone from 40% of GDP to 200% today, this second, right now. Why? This demonstrates how money supply, measured primarily as M, M1, M2 growth, and again, there's a lot of arguments about how you measure money and if you can even measure money, but for the sake of this argument, money supply is not required as the only mechanism to pump new money into the system. Remember, fake money can look a lot like real money, especially in an environment where all money is kind of fake money, right? And then it gets real loose on what the actual definition of money is and can anyone define it. So Keynesians and monetarist macroeconomists have defended QE as not actually being money printing, but bank reserve creation instead, and thus non-inflationary, right? And technically that is accurate. This is true, but only in a semantic and academic sense, using their predefined measures of inflation, measures that carry little relevance in modern reality. Okay, it's a kind of circular logic. So, and I subscribe to this too. Bank reserves can't buy hamburgers. However, they create a pattern of behavior at the banking level where money is created. And this is the problem. He continues, the bigger problem with such definitions is that they entirely miss the point. Why print more actual dollars if banks are regulated into holding higher excess reserves and are not going to turn them into credit anyway, right? It makes no difference. Credit is the actual mechanism for money printing in our system. This is why this is the paragraph that got me to really like this guy. Credit is the actual mechanism for money printing in our system. And money velocity, the residual multiplier effect on base money, has plummeted. In 1997, the velocity of money peaked at 2.2x and is currently dramatically down 50%, now sitting at an all-time low of 1.1, half. That means that every dollar of money in the system in 1977 was recycled over 2 times. Adam Smith's invisible hand, right? So in 1997, so we'll call it 2000, every dollar was recycled. Okay? So let me go back again. In 1997, the velocity of money peaked at 2.2x and is down now to 1.1x. That means every $1 of money in the system used to be recycled 2 times, but is now not recycled at all. It doesn't even get a double. The Fed sees this declining velocity and becomes alarmed. In order to reach their goal, they must therefore print 2 times as many dollars, even if it's fake dollars, than they previously did in order to have the same effect on broad money circulation. The problem is, if you keep printing bank reserves, but the banks don't take that money and extend the credit, you have a logjam. The timing of this peak is also interesting. This occurred right when the gears of moral hazard were really beginning to churn internally. Okay? Events such as the bailout of long-term capital management, the concept of the Fed put entered the economic zeitgeist, when the Asian financial crisis, topped off by the dot-com bubble, all occurred within a few years of this peak in monetary velocity. It's also no coincidence that the policies of financialization also began to accelerate during this period. In 1996, the Federal Reserve reinterpreted Glass-Steagall, I think we talked about that, to allow for more collaboration between money center and investment banks. Probably the worst thing that ever happened. In 1996, NASDAQ futures began trading on the Chicago Mercantile Exchange. In 1997, long-term capital gain tax was reduced from 30 to 20%. In 1997, E-mini S&P future contracts also began trading. In 1999, right before the dot-com crisis, Glass-Steagall was fully repealed, and money center banks became fully entrenched in capital markets once again, right? Bankers became investors. Banks, the place that's supposed to be safe, started taking your money and gambling that shit into the market with leverage. Why? Because they could. No more Glass-Steagall. Nothing standing in the way. The Commodities Futures Modernization Act was passed in 2000, deregulating the financial derivatives markets. This helped set the stage for the next crisis in 2008. That leads me to this chart. Okay. The chart below shows a strong relationship, well, not below. The chart in front of you shows a strong relationship between the growth in the quantity of money, M2 growth, and traditional measures of goods and services, inflation, PCE index, right? In 1970 and all the way until about 1997, when these two paths would diverge, right, that would show somewhat healthy markets. Okay. Instead, money supply began to correlate much more with financial assets like the stock market. This is the problem. Once they started to correlate, it meant that more money appearing in the system meant, and of course it's obvious, right? More money flowing into the system. It's not showing up in your pocket. It's showing up in financial markets. So basically the printing press hoovers up future prosperity and spits it into these markets almost directly. Thing is, everybody doesn't have equal exposure to these markets. This isn't a fair, decentralized system, right? Not for most people. Such policies and events as those listed on this graph represented an intentional and aggressive shift in money and monetary creation. A more potent economic policy ideology was realized to induce the inflation of asset prices via deregulation, right? Deregulate, prices go up. Lower capital gains, prices go up. Increase leverage, prices go up, right? Add new financial products, prices go up. Passive investment vehicles like Vanguard, prices go up. Exchange traded funds, prices go up. ETFs specifically, they can be thought of through the Silicon Valley lens as a technological innovation enabling a better user experience for individual investors, right? They stimulate greater equity market adoption and fungibility for the public. Adoption and fungibility are the key attributes here. Since the dot-com era, more such innovations were then developed, such as creative derivative instruments housed within a new shadow banking architecture to better propagate household debt and even large fees in the process. I am, of course, referring to the period leading up to the real estate bubble and the financial crisis of 2008, which they will, of course, blame on you because how dare you want a freaking house? How dare you? But it wasn't the people that wanted houses that ruined the market. It wasn't people that wanted houses that were taking on debt without the banking system extending that profligate debt. And the problem of low liquidity and the problem of bad behavior on the part of these investment banks. But again, this was a whole system, a whole policy shift, which was the financialization of everything. And this very clear ideology used to inflate asset prices with these mechanisms: deregulation, lower capital gains, increased leverage availability, increased credit availability, passive indexation vehicles. Mike Green talks about this all the time, and ETFs. Every one of these mechanisms is meant to channel money, currency units, out of society and into these financial markets. And it gets to be where people just say, well, if I don't participate, I lose because I'm losing buying power because they're stealing from all of us. So if everybody is losing their future prosperity, if it's getting stolen from everyone, but you're not all invested, you're not all participating, then it's getting stolen equally, but distributed disequally. Does that make sense? So that's what's going on. It's not pretty, man. Let me give you another chart. So this is the ratio of household net worth to nominal amount of wages and salary in the U.S. Current ratio of Q1 2021 is 13.8x, a record, like a big record, huge record. Its pre-Great Financial Crisis average was 8x. Yeesh, post-GFC. But prior to COVID, it was 11.5x. So it's still a record. Biggest shutdown in 100 years. We shut the economies down. And yet, household net worth to nominal wages has gone up. Does that make sense? The economies are shut down, but we're all doing way better. Wait a minute. Where did the productivity come from? We turned off all the machines. There's a good quote here. Inflation is an alchemist's time machine and the cat burglar of our future. A recent iteration of this has been the gargantuan issuance of corporate debt at its most base level, designed to boost equity returns, right? Companies take on debt, buy their own stock back, take on more debt, buy their own stock back. If you can borrow for free or next to free, and you can buy your own stock and jack up the prices of the stock and pay yourself fat ass bonuses. No, but that's not moral hazard, right? That's just doing business. Pretty sketchy if you ask me. Sounds a lot like a Ponzi scheme, a deregulated, legalized Ponzi scheme. Anyway, this is all designed to boost equity returns in this post-2008 era and through today. This has gone hand in hand with stock market inflation, similarly fueled by perennial subdued interest rates. Keep the rates low. Make it easy to borrow, to buy your own stock back, to F the markets, right? So the theme of the past decade has been corporate and government debt proliferation and dramatically lower nominal interest rates. Wall Street froths at the mouth at such lower rates, using convoluted descriptions to describe the situation. And they say it's an improved discount rate environment, justifying a lower equity risk premium. What they really mean is that such circumstances make the stock market number go up. If we do these quasi-illegal bullshit things, stock market go up and to the right. This is because for long duration financial assets that have high projected future cash flows, such as growth stocks that dominate the stock market today, and these memey bullshit stocks that are getting propelled out of insolvency simply by a bunch of people on Reddit, analysts tend to determine the present value of these cash flows, of these future cash flows, using a discounted cash flow, a DCF model that takes a prevailing discount rate, usually the risk-free rate. By the way, when you hear risk-free, it doesn't mean free of risk. It means only free of credit risk. There are a whole bunch of kinds of risk. Credit risk is one little bitty part of that equation, probably the least valuable of those metrics. So when you hear risk-free, it only means credit risk-free. Okay? All right. I digress. So the risk-free rate, like the long-term treasury yield plus some risk spread. To deflate these future earnings, they do this to arrive at an intrinsic value, and that's how they value these assets. The lower the discount rate, the higher the present value, right? Bing. So if this sounds a little bit like alchemy, like weird science to the readers not employed in finance, or those of you that are listening, it's because it is. It is all smoke and mirrors bullshit. It's things that people say to sound smart when they don't know what the fuck they're talking about. And they all know, or maybe they don't, that it is theft of future value by the people in the present. It's the old man smoking a cigarette, spraying hairspray straight up at the ozone layer, saying, fuck my grandkids, I'm cold now, right? Historically, in freer times, interest rates fluctuated based on market dynamics. Imagine that. Prevailing equilibrium, time preferences. Imagine that. Imagine free markets being free. Consequently, any discounted cash flow model, DCF model, historically was just an oscillating cycle of value being extracted from the future by the present as rates declined, and then returned to the future once rates moved higher. But with rates now continuously suppressed out of necessity by the Fed and the nod of these compliant central planners that don't know what they're looking at because they can't even read a fucking balance sheet, this has become permanent theft. We are permanently stealing. We aren't. There is permanent theft being perpetrated against your future all the time, in real time. Basically, go fuck yourself. The thing is, we're not all participating equally. Everybody's not participating. So if you steal from everyone and everyone's not participating on the winning side of the winner-take-all businesses, then this system starts to look really skewy, and you start to go, oh, it makes sense why we have these huge, wealth disparities, the wealth gap, the wealth divide, whatever you want to call it. And it's going to get worse because this stuff, it takes more and more to get velocity. It takes more air to get the same amount of expansion in the balloon. When the balloon's as big as a house, a breath or two won't cut it anymore, right? So this is why we tend to witness more winner-takes-all businesses, more dispersion of success between those with access to capital and those without. And just in case there are any delusions that the current policy is not indeed permanent, let it be reminded that the Federal Reserve, as of the end of 2020, now holds more U.S. Treasury securities than all foreign central banks combined. The Fed owns all of their own bullshit with coupons, right? In comparison, during the 2008 Great Financial Crisis, this level was about 25%, which is still a lot. It's massive, but it's not 95%. Apparently, each crisis gets greater than the last. Never let a good crisis go. It's like, ugh. Anyway, the degree of greatness was nearly 4 times that of the previous crisis just 10 years prior. So there's something profound about the realization of permanent time theft. And once we zoom out and try to absorb its myriad implications, in theory, the potential future supply of capital is infinite as long as time does not end, right? And as long as we continue to have faith or believe that the world continually improves over time and creates ever more abundance and affluence. It never goes backwards. The stock market will never sell off. People will never take profit. Everything only goes up. Housing will never go down, ever. It only goes up. Does that sound weird? So for now, these 2 key assumptions remain intact. And there's less and less intelligence kind of backing these theories. Doesn't matter. There's less and less education. Doesn't matter. The average investor's IQ is lower and lower. Doesn't matter. Right? But for now, these 2 assumptions, that we will continue on in perpetuity, that everything gets better and more abundant, and that everybody will be rich. And as long as these assumptions are intact, we continue to steal from the future. Permanent time theft. If there's nothing else you get out of this, permanent time theft. That is what's happening. And that's what everybody's buying into. Out of desperation, we have synthesized ways of funneling this capital with an alchemist time machine back into the present. The implications are now that we can create theoretically limitless amounts of money in the present by convincing each other of the prospects for a brighter tomorrow in one breath, while stealing from that future conviction before even exhaling. This is the inflation of epic proportion. It's the inflation of the perception that everything only goes up and it's okay to steal from that future. That's the inflation that we should be thinking about. Financial assets are now fiat stores of value. In a recent interview, legendary investor Stanley Druckenmiller noted that corporate debtors were now borrowers of $1 trillion in 2020. This guy works in the industry and witnessed the insanity firsthand. As Druckenmiller noted, we've never seen in history private debt go up in a recession prior to last year. It's never happened. So when people say things are different this time, it's the same bad behavior, but things are different. Private debt went up in a recession instead of an unwind. Typically in downturns, private debt collapses by as much as $500 billion in today's dollar terms. So we're talking about a 3x increase in leverage during a fucking recession. This shit is mind-blowing. So we've been encouraged for over 30 years to hold assets as a perceived store of value, including equities, debt, real estate. Yes, real estate has always been a store of value throughout human history, but not the equity portion of leveraged real estate. Guess what? You go take out a home loan. You don't own your house, asshole. Someone else owns it, right? Even in the early days of fiat, loan-to-value ratios were 50%. Most other countries still have loan-to-values that are conservative like that. You have to have half the money to go buy a house, 60, 70%. But not in the US. No. We went from 50% to a bottom between 0 and 10% in 2007 and back to slightly less than 20% today, meaning you pay 20% down on a house, 10, 15, 12, right? You don't own the house. I'm an owner. Bitch, you're not an owner until you own it, right? It's no different than leasing than really is like a lease, but it's like getting a car note, right? But it's still debt. It's not actually real estate. You don't own it. So it's basically fractional real estate. You own a little piece of it, a claim on it. You're a lien holder on your house, but you're not the lien holder. So a way to promote greater adoption without having to actually address the thorny issues of valuation and affordability. Oh, sure. I just believe that I own it. I'm a homeowner. No, man, not your lien, not your house, not your keys, not your crypto. So the implicit and subconscious narrative over the past quarter century is why hold cash? Instead, hold the assets that are inflating via implicit guarantee behind that cash. How then are financial assets any different than fiat as a bearer instrument? Moral hazard, therefore, is how you print money today. You print it through moral hazard. You print it through theft of future prosperity, right? You keep rates abnormally low for an extended period of time. You extend the credit risk-free addressable market. You stimulate adoption with the carrot, which is moral hazard, right? And the stick, stealth debasement of cash and savings. Stealth debasement of cash and savings without damaging the reputation of the fiat currency unit of the day. Du jour, the dollar, right? You trust the dollar. Debt, assets, and confidence. Three-legged table. As long as there's continuing piles of debt, people think they own assets, and there's confidence in the currency unit of the day, everything's peachy, right? Voila. The outcome is what QE has been most advantageous in realizing. The opportunity cost of 100 years. Rather than focusing on the impending inflation decade, we should be focused on how much deflation we could be achieving, because deflation, for technological reasons, is incredibly good. It is empowering. It lets everyone or more people have exposure to the kind of technology that makes our life better, right? So we could be achieving more good, hopeful inflation if we were to stop fighting it, thinking that inflation is bad. Oh, we're in a deflationary environment. They say it like it's a bad thing. The fact that you don't have to stand in gas lines, the fact that you can get bread no matter what in 2 days, the fact that we don't have these log jams and all the food leaves the shelves except when people are stupid, right? We cannot battle the progress of inflation, of innovation and technology, right? You can't subdue that. You can't put baby in the corner. You can't put the rabbit back in the proverbial hat when it comes to the tsunami of compounding innovations of the recent and near future and what they imply for human labor. What levels of deflationary abundance would we already have accomplished after a century and a half of accelerating technology innovations, most of which occurred during regimes of increased centralized coordination over economic activity and an eroding ethos of liberal doctrine? Okay, that's going to be gobbledygook for most people. Just think about this. Think of what we've accomplished relatively recently and how incredibly powerful that is. Imagine if we weren't standing in the way. Imagine if we weren't trying to choke out technology because we label it deflation. Imagine that. So an impartial and inquisitive society should be conducting a fair and honest inquiry into the question of whether we have truly ever experienced a free market and liberal society. And if money is one of humankind's oldest instruments of freedom, right? Can a centralized and fiat evolved monetary system contain the necessary ingredients for a genuinely free society? If the answer to these questions is a resounding no, then one must ask how the bounty of innovation and innovations humanity has achieved in the modern era could have led to an even greater degree of progress and wealth creation had they inhabited a better system, right? Had they been allowed to run free, had we embraced technological deflation, right? And further, how could these achievements have compounded over time to arrive at a completely different place than where we find ourselves today? The opportunity cost of having not followed this path is nearly incalculable. Franklin Delano Roosevelt said, this is his quote, "Not that the system of free enterprise for profit has failed in this generation, but that it has not yet been tried." Think about that. Not that the system of free enterprise for profit has failed in this generation, but that it has not yet been tried. We haven't seen a really free market, a truly free market. Just haven't seen it. We haven't been exposed to it. The story we should be telling: the current fiat system and the monetary and fiscal policies that have evolved to sustain it will not necessarily lead to the 70s era style kind of headline inflation figures, because our world is drastically different. The policies and behaviors they invoke will continue to lead, to prodigious economic damage, right? So bad news is coming, but not the same bad news. New bad news, right? The trajectory of the current system is spreading a cancer that is slowly eating away at our free market institutions and our future prospects with a laundry list of destructive characteristics: moral hazard, extremely misaligned allocation of capital. Extremely, right? Zombie companies that don't deserve a fucking dime. Companies that need to go broke, that need to be bankrupt and broken and handed to competent fiduciaries. A vulnerability to cronyism, populism, nepotism in politics, nepotism in stimulus. The cantillionaire effect, right? Where a few people close to the pump make money and everyone else gets stuck. Did you receive your equal portion of all the stimulus funds that were handed out over the last year? No, because only $1 in 10 ever escapes the crony system. Dude, it's a scam. And it's all just stacking on top. Greater centralized planning, more censorship to maintain control over the increasing volatile foundation, less economic intelligence in the media. It doesn't, listen, they probably, I say they, the financial media, don't blame them. They get their marching orders from people above, but they're mostly stupid. There's 2 or 3 people that know what's going on, and everybody else, they're just collecting a paycheck, bro. They're just reading the teleprompter and going home. They don't give 2 shits what's going on because they got it good. Anthropomorphic principle. If you wake up in the morning and you look out your window and all you see are Ferraris and Bentleys, you think that's the way the whole world works. The sky is pink to you, and no one's going to tell you any different, and they're not going to rock the boat because everyone looks out and goes, you know what? This is all too big a problem for me to fix. And maybe they're not wrong. Finally, yes, even pockets of traditionally defined inflation, from effects such as Baumol's cost disease, most notably in healthcare and education, to essential and inelastic services. We could do a whole healthcare and education thing. That's a damn quagmire. But the trajectory of the current system is also, it also importantly requires more debt in a mounting negative feedback loop. The debt's not just a function of trying to solve a problem with the completely wrong solution, but also a requirement of the resultant government debt burden and its intractable servicing costs. At some point, if you keep running up debt, someone is supposed to service that debt. Now, the MMT idiots will be like, it's cool. It's cool because we just keep printing and we just pay off our debt with printing. Okay, bro. QE and fiscal policy have become so intertwined that differentiating our current political economy from ideologies such as modern monetary theory has become a truly Herculean task requiring skilled academic gymnastics to deflect. And the thing is, a lot of these people are really good at arguing old Keynesian and MMT bullshit. They're injured by their intelligence. They're just smart enough to present these arguments in a really good way. They're too ignorant to understand how flawed they are. They don't see the forest for the trees. They have marching orders, and they just get really good at explaining their game, even if it's a flawed game. To carry the analogy, the end game ever and always in these cycles is a subsidy of government borrowing. More borrowing, bigger debt, more debt service, for more borrowing, for more debt service, for more quasi-stimulus, for more borrowing, into absurdity. In the world of macroeconomics, we refer to such behavior as financial repression. With a growing level of unemployment without a commensurate decline in the cost of living, our current system will require greater and greater piles of social spending to compensate. This means more debt, which crowds out even more new capital and further damages the system in a spiraling degeneration. Debt, assets, confidence. If you bloat one of the legs of a table, it eventually gets so big that the table still collapses, even though the other three legs might exist. The laundry list of problems just stated are all existential issues for our fiat system, but none of them require a dramatic realized rise in any aggregate inflation gauges to have disastrous consequences and lead to continued debasement of fiat currency. This is shadow debasement. Does that make sense? So the reason why I like Bitcoin because of bad government behavior. I think I've said that a few times. Shadow debasement, this debasement that happens behind the scenes, while it may not be the headline inflation that everybody talks about, it's incredibly more dangerous and detrimental. We like Bitcoin because it is an ancillary, because it is a choice that you can make. When there are problems in society, you can raise your voice and scream, or you can exit. There's going to be costs associated with both of those, right? But you have those choices. Raise your voice, and Andreas Antonopoulos talks all the time. Raise your voice or exit. Those are your choices. Sometimes both. Okay? We like Bitcoin, or we should like Bitcoin, because of the opportunity it gives us to not participate in stealth debasement, or at least to have something that loosely tracks bad government behavior. Right? Okay, so if we use existing aggregate inflation gauges as our barometer, then the loyalists of the current system will continue to get away with dismissing the skeptics and confidently reassuring the masses that all is well in the world of fiat. If that's the only thing you look at, you're missing the big story. That's kind of what the base case here is. But not all is well. We sense it, we smell it, we taste it. As mentioned above, the fiat system has devolved backed into a corner, surrendering to a life of crime and stealing from our future selves. The problem with such theft is it's multifaceted. Okay. First, not everyone is a thief, but every future self gets robbed. We're all getting robbed, but we're not all stealing. We're not all benefiting. Consequently, the prisoner's dilemma culture is constituted that incentivizes everyone to participate in this robbery so as not to get left out in the cold, holding the proverbial bag. Unfortunately, not everyone can participate in such a game. Everyone doesn't own stock. Everyone doesn't own crypto. Everyone's not investing. Everyone doesn't own a house, right? Especially those who are not even aware of the game that's being played. How can you participate if you don't even know the game's being played? If you're just working a 9 to 5, you're just trying to scrape by, you don't get to participate. Well, hold on, you get to participate in being robbed. You're a part, you get that. You get to go home and have less buying power every day and every year. Another problem is that this dynamic breeds instability and fragility, right? The more we chip away at our future building blocks, it's like you have a bridge and you're stealing bricks from the other side of the bridge that you have to cross in order to pave the first part of the bridge that you're on right now. But what happens when you get halfway out and there's no bricks left and you still have to continue into the future? You built yourself a cliff that you have to go off of. So the more you chip away at future building blocks, the more you must hope for new blocks to be constructed by somebody else, robbing from the future to replace those missing, lest the foundations begin to crumble and decay, and off you go. And if you lose faith in the future, this is the thing, if, debt, assets, confidence, if we lose faith in the future, confidence, if it goes away, the entire illusion evaporates overnight. Poof. Then we are pressured by an imperative to constantly sell our present selves increasingly seductive visions of the future and future prosperity, no matter how vague and unreliable and unsubstantiated they might be, how grandiose and nonsensical. And no matter how much our current behavior reduces the probability of such a fate materializing. Do you think the average investor is more intelligent now than they were a year ago? Remember, think about all the new people, the pump and dump society we live in, right? The story stocks, the SPACs, the meme coins, poop dumpster, and all these other stupid ass things. People, Hertz, AMC, GameStop, go down the list of shitty companies, Ford. People are investing, they don't even know what the fuck they're buying, but they're doing it because they know that someone's going to come and bail them out. That's the assumption. I know people that trade that don't even know what the fuck they're trading. They're just trading squiggly lines on a screen. So do you think the aggregate intelligence of the investor now is higher or lower than it was a year ago? And do you think that's healthy, regardless of your answer? Do you think that's healthy? Do you think this means the future looks better? It's a bunch of fucking retards. It don't look better. So the dream that we're selling each other can't possibly materialize. We just have to finance it. And how do we finance it? By stealing from our future us. This is what we're doing. It's just a theft. It's a theft of future prosperity, a constant and continuing escalation of abuse. That was my part, by the way. That's not his. He was much more subdued. Taking our hands out of the cookie jar. The types of inflation unearthed above should worry us much more than the 70s-esque overt, cynical or cyclical inflation that generates uncomfortably high gas, food, and electricity bills. The reason is the above types of inflation are insidious and shockingly easy to obfuscate. While the second type, the kind of very obvious eggs cost $8 argument, is very obvious and relatively easy to address if the public and political will exists. This is the story that Bitcoiners and cryptocurrency owners should be talking about and exposing. The stealth debasement, the stealth theft of future prosperity. Not headline CPI. The fact that lumber's more expensive. Big fucking deal. So, and this is his final thought. I'll conclude with one more related point. By focusing our attention only on the shorter term goods and services type of inflation that we've been instructed to fix our gaze upon, we unwittingly de-emphasize consistent but low headline inflation. And this is something that not just me, but Jeff Snyder and a lot of people have been saying. Where's the inflation, bro? I get the stealth debasement. I believe in the debasement argument. The theft of future prosperity. But where's the actual real headline inflation? We refashioned something unacceptable into something mundane. Policymakers and government officials have told us over and over and over that such inflation is not only innocuous, but actually desirable. The Fed says it's a good thing. We want to get that inflation up as a sign of a good market. It's backwards, bro. By decreeing 4 to 5% inflation as a sign of impending monetary ruin, we minimize the degradation caused by a quarter century of compounding 2% targeted annual inflation. Think about that. They are targeting 2%. You guys know where this, what, in science, what happens. We're acquiescing to a 50% erosion of our purchasing power every 20 years as a matter of course. This is mathematics. This is not speculation or whimsy. 2% target annual inflation creates a 50% erosion in purchasing power every 20 years. So if you have $100, 20 years later, you can buy $50 worth of stuff. 20 years later, you can buy $25 worth. So 60 years into it, your $100 buys you $12 worth of shit. I'm reminded here of Goodhart's law, observing that when a measure becomes the target, it ceases to be a good measure. Low but steady inflation can be gamed by the owners of capital within such a system. Low perceived inflation also fuels greater moral hazard simply because of its assumed predictability, as if we know what the future looks like, other than more theft and more moral hazard. The more predictable the target is, the more risk one can take in gaming and outmaneuvering that target. So financial leverage and indebtedness invariably rise. Capital misallocation rises. False sense of permanence and stability increases. It entices us to reach deeper and deeper into the cookie jar of the future, hoping that nobody notices there are no cookies left, that the jar has been empty for 50 years. There are no cookies. So all this may sound dire for the economic prospects for our children, but this is also why Bitcoin, and to a greater extent some of the other digital assets, or to an equal extent, is such a beacon of hope for so many people. Why it has this transcendent power and is so often and so intensely appreciated once these challenges are fully comprehended. Once you start to understand how fucked up the world is, digital assets make way more sense, right? Bitcoin puts the cookie jar back in the cobwebbed upper reaches of the kitchen where all of the assholes can't get to it. It liberates us from the temptation to steal from the future, right? So absorb, think, let that bounce around in your brain box. I know we went a little long, but this stuff is kind of important. And if you're framing your argument for Bitcoin correctly to yourself, okay, this isn't about talking other people. I don't give a fuck if anybody else gets into crypto. I'm done doing that. I'm not explaining shit to anybody. People that aren't here, that aren't already in the space, it's not our job to convince anybody. It's your job to protect yourself, right? Protect yourself first. The lifeguard can't save anyone if he drowns. Your job is to yourself and your immediate family. And I'll be honest, right now, it ain't about the next man. This is about protecting yourself and understanding that this is the world we live in now. A world of idiots, a world of imbeciles, a world of fucking retards. You got to protect yourself and make sure that you don't fall down that path and that you start falling in with a bunch of idiots, a bunch of fucking rubes in an echo chamber where all these dickheads regurgitate the same crap over and over and over. Oh, we rub each other's backs. We all feel good. Woo, woo, woo. No, man, it is not good. Things are not good. And then you see these comments. Well, I'm not hating these gains I'm making with Cum Rocket and Spooge Dumpster. Get the fuck out of here, man. You're just buying lottery tickets. Go to Vegas and buy your fucking lottery tickets. You're missing the point. Winning a lottery, you'll give it all back. You didn't do anything to earn it. You want to earn it? All you got to do is a little research. That's all. All you have to do is just absorb and observe. You don't have to be smarter than anyone. And you don't have to outrun the bear. You just have to outrun the fat kid. And guess what? These markets are full of fat kids. So I would just urge you, this is a video you may want to play in the background because this is such a well-structured description of the project that we have. I got to give it up to Aaron Siegel. A really cool opinion. I don't even think he's a big crypto guy as far as like he's in crypto, but I don't think he's a big like possessor of a bunch of crypto, but he has him some Bitcoin. So don't get caught up in the nonsense. Absorb and observe and just try to raise your own total market awareness IQ. Cool? Okay. Have a good day. Stay out of trouble. Stay in school. Don't do drugs. Don't do anything my poor insolvent, drunk, high as a kite, strung out on meth grandmother wouldn't do. Good news, she doesn't have the Ouija board out. Bitcoin's at 40K, so she's happy. But she's sad. She's waiting for it to get to 20K again. Pfft, grandma, don't be that guy.
Hey, this is the Prophet with Nick Black. It's time to chit chat. You know nothing about blockchain. We here to fix that. You want the news on them new stocks? This where you get that. So go and grab you a nice chair. It's time to sit back and talk to Prophet. Hey, hey, you talking to the Prophet? Hey, hey. We talking condos and nice clothes and dropping Lambos. I remember them night codes, we couldn't stand those. We tried to drive on them house roads, but had to stay low. Now there's solutions to hard bills we couldn't pay for. I talked to Prophet to get some profit, we couldn't change the top. If it's a stock and I need to cop it, I wait for him to drop it. Ain't no option, let's get it popping. We chilling in the trap. I need some crypto, put it in my pocket. By any means I rock. This is the Prophet with Nick Black. It's time to chit chat. You know nothing about blockchain, we here to fix that. You want the news on them new stocks, this where you get that. So go and grab you a nice chair. It's time to sit back and talk to Prophet. Hey, hey, you talking to the Prophet. Hey, hey, you talking to the Prophet.
It's all fake news. It's phony stuff. It didn't happen.